This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning John Rubino, well-known author and publisher of the website dollarcollapse.com. Good morning, John. Welcome back to Macro Analytics.
Morning, Gord. Nice to be back.
John, let's just jump right into this session. I wanted to do it on the shocker we had from the Fed on what I'll call reversal. A reversal, least of expectations that they had put out into the market of what they were planning on doing, and we had all the speculation of what it would be in September. And what I'd hope we do is break it up into two parts. One, what spooked the Fed specifically. I know you've got some views on what that is. I've got mine, and I thought we'd kind of each take a shot at what we individually see them to be. And then based on that, what are the consequences? What you and I individually see the consequence of these decisions to be, because they, in my mind, are very, very serious. What the Fed said, I have a slide here. This is the official word or reason, was tighter financial conditions, and they weren't quite clear on what that meant, but basically it was the mortgage rates, bond going up, and therefore just really shutting down mortgages dramatically, and they're concerned about the flow from that. Second, policy uncertainty. They were more specific there, the upcoming fiscal debate in the U.S., whether we're going to have a government shutdown, the debt ceiling, etc., and that they've been on this for Fed, at least, harping on this for quite some time, so they're concerned about that. And then just more data they claim is needed, and I think they're reflecting there on the labor market just hasn't been increasing. But it kind of makes sense that that's on the surface, or at least it's the surface of what is a rationale, but I think there's more to it than that. I know there's more to it than that. I've got your list of what you think's behind it.
The Fed had an awful lot of data to look at this time around. On the one hand, it had the stock market hitting record levels and real estate, at least earlier in the year, spiking. And so you could infer from that we're heading into another period of asset bubbles, which was part of their rationale for wanting to scale back the amount of money they're pumping into the system. But on the other hand, you've got some really bad underlying economic numbers. GDP growth is decelerating instead of accelerating. So that means that all this money they've thrown into the system has not had the desired effect of causing the economy to begin to grow organically, where aside from the money that's being pumped into the system, activity is picking up. And instead, it's slowing down. And the jobs market, even though the top line number, unemployment, it seems to be getting better and it seems to be moving in the right direction, the underlying numbers are terrible. Most of the new jobs that are being created are part-time jobs, which means they're not the real job anybody wants. They're something that you take until a real job comes along. And for women, especially, 60% of the new jobs that women have gotten in this quote-unquote recovery pay less than $10 an hour. So if you have a part-time job, let's say you're working 28 hours a week, you're making $10 an hour. That's less than $12,000 a year. That's not something you can support a family on, or even something where it's worth getting up in the morning to do for most people. And yet that's the kind of job that is being created in the majority of cases out there right now. So that's not the kind of market where you tighten normally. And then you've got all these uncertainties out there. The new healthcare law is one of the impetuses for companies to move people to part-time work, because then they don't have to offer them these really expensive new insurance policies that the government has mandated. And for people who have to buy their own insurance, it looks like me, for instance, it looks like the cost of new policies is going to go through the roof. So you've got that uncertainty out there. And then you've got the debt ceiling debate, where both sides seem to think that they can win a game of chicken, where they let the government shut down some important programs for a while. blame the turmoil on the other party, and then win politically. So we're heading for something like that in the future, and that's the kind of thing that will slow down the economy, other things being equal. And then you've got cities rapidly deteriorating financially, and Detroit's already bankrupt. Chicago, it just came out in an article published by Mike Shedlock that their pension funds are only 31% funded. That's a catastrophe if they intend to get to full funding, because it means they have to divert huge amounts of money from other programs just to pay for retired teachers and police and street workers, people like that. The pension liabilities in Chicago now come to about $61,000 per household. That's a huge burden on top of everything else. That's on top of your mortgage and your car loan and your credit card loans. You've got $61,000 that your family owes to cover the pension plans that your city has instituted over the years and never fully funded. Meanwhile, one more stat, median household income, which is the main measure of the welfare of a given family in the U.S., has actually been falling since 2006. In real terms, it's down from $55,000 to $51,000 a year. And so that's also not a sign of an improving economy. That's a sign that things are getting worse for most families. And to the extent that new wealth is being created, it's all flowing to the top 1%. So you add it all up, and for the Fed to tighten at this point is extremely risky. And, you and I have been talking about this for years, really, that QE can't end. They really don't have the ability to just stop pumping huge amounts of money into the system because the system isn't responding. It's not working. Or it's working to the extent that it's avoiding a 1930s-style deflationary crash, but it's not working to the extent that it's causing the economy to begin to grow again and quote-unquote normal times return. This is not normal in any shape. And the Fed is bumping up against its need to slow down or slow down its asset purchases and its money creation, and then realizing that when push comes to shove, it can't do it. So that's what we saw this past week. Everybody thought the Fed was going to slow down their asset purchases, and when it came time to actually make the announcement, they couldn't pull the trigger. And they probably will be unable to pull the trigger going forward because things are decelerating. A month from now or 2 months from now, things are actually going to look worse than they do today. So there's not going to be rationale for slowing down, and they're going to have to do this forever, basically.
Couldn't agree with you more, John. Matter of fact, I believe, everybody's now talking about taper starting in December, and I believe by then the R word will be the operative word, and that is recession. And because everything is rolling over, and then there'll be another set of reasons. I think this was their last shot. But we have never seen, I recall, such a dramatic shift against expectations that were set by the Fed going into an FOMC meeting. So something dramatically shifted since they started talking about it in May. But I agree with your points. There's as we just saw, a litany of reasons, but I distilled it down in my mind to 3. Remembering, though, before I go through the 3, that the Fed's decision to postpone any tapering is a result of its own blunder. It misread the impact of its May decision to begin discussing the strong possibility of reducing bond purchases in a few months. It subsequently, as I recall, compounded the error through it had press conferences, congressional testimony, and numerous speeches. Both Bernanke and the Fed governors, all of them strongly hinted at imminent tapering until less than 30 days ago. So the Fed officials themselves heavily influenced the expectations to the point where overwhelming majority of the street expected at least a minimal reduction in bond purchases at the meeting, and the Fed, through its numerous spokesmen, allowed and encouraged this consensus to form with little attempt to walk it back at all. So to me, it's what changed. I mean, what changed so dramatically in the numbers? There's 3 things that come to mind. They're not as obvious as everybody might think. The G20 pressures. That G20 summit recently in St. Petersburg, to me, shed light on the seriousness of the concerns surrounding the plummeting currencies in at least 3 of the BRICS, Brazil, India, and South Africa, all in the G20 meeting. But away from the glare of the media, the BRICS were cobbling together, right there at the meeting, and an emergency $100 billion currency reserve they called a firewall fund, with China and Russia bringing in the money. Additionally, they had urgent side meetings going on to finalize this new development bank. They were negotiating, capital structures, membership, shareholding, governance, with an initial subscription of about $50 billion. All while this G20 meeting is supposed to be focused on Syria. So when the emerging markets did participate in the main G20 session, it was clear that what the BRICS agenda was, and their focus was the impact of the U.S. monetary taper direction and the apparent U.S. disregard for the global consequences. Remember, Bernanke was there as the U.S. U.S. Treasury Secretary was also getting beat up by their counterparts. And I don't think I've ever recalled Obama coming back quite as clearly beat up as he did. And the BRICS basically felt that they either impose capital controls or let the Fed run their economies. So they were attacking Obama and Bernanke with what was going on with U.S. monetary policy. And if it hadn't been for three stunning developments that I've never seen anything quite as significant occurring following immediately that G20 meeting, where everything was unwinding at an increasing rate, we'd be in an incredibly serious position at this point. But the three things: first, we had an abrupt reversal in the U.S. Imminent attack on Syria, initially by Obama, unexpectedly deferring to Congress the decision, then just as surprisingly negotiating a temporary diffusion of the situation. We've seldom ever seen such an abrupt face in U.S. policy stance right off the bat. Then secondly, we're just kind of a few days later, we're getting over that shock, which is having profound impact all of a sudden to the rest of the world, because they were saying if we go into Syria and the shooting begins, what it's going to do to the global slowdown and its already acceleration. That's the key point here. Secondly, Len Lawrence Summers stunned everybody by withdrawing his name consideration for the chairman of the Federal Reserves, and the emerging markets it just leaped on the news. I mean, the markets, everything were up dramatically. Currencies rose. I mean, it was phenomenal shift just on that announcement. Never mind the U.S. stock market. And then thirdly, and the most important one we're talking about here, the Federal Reserve then shockingly defers the taper out of nowhere. And so what happened here is, I think that it was so clear that the U.S. that this had to be a macro decision, not a U.S. economic decision. And John, as you correctly point out, there's no question from a U.S. point, we're right on the verge of having to do this. But I think the push from the G20 meeting and the rest of the world was a phenomenal pushback. And being pragmatic, Obama looked at it and said, look, if the world is slowing down at this rate, look what's going to happen to our exports. It's going to force us into a recession. So there was that element. And then back to the U.S., the second point here is this U.S. recession. I was looking at the Christmas stocking orders. They're a disaster. So all of the retail trade around in the United States, real trade, is expecting a very, very slow Christmas, which is, in a 70% consumption economy, and we've already seen in these charts I have here, is showing that the retail traffic has been falling off consistently for a protracted period of time because disposable income hasn't been keeping up. And what we have is that we're using our savings to just maintain our spending. And so there was that element. And then I think the third, John, just to wrap up here, the third is I think that with Summers withdrawing, it looks like Yellen is going to be the new Fed chairman, and Bernanke's just not going to leave her with a policy that she's going to have to come in and change and reverse and say, because she would not support right now implementing taper. She would push it off because the PCE in her mind, inflation is way too low. That 6.5% unemployment target is clearly in jeopardy. So she would not go. So you really can't hand it to her and then have her turn around and reverse it. So there must have been some dialogue going on in the last few weeks as she was clear, or at least even right up to the 11th hour, that she would have a different view. They must have asked her, and that may have been the final push over the hump. Any comments on that?
Yeah, there was a lot to think about for these guys in the last couple of weeks.
Exactly my point.
And, the emerging markets are especially interesting here because they started to just tank right after the tapering announcement in the spring. And the reason for that is a lot of the hot money that had flown in to the emerging markets over the previous few years and had kind of destabilized them in that way by pushing up asset prices and pushing up their currencies, began to flow back into the U.S. And that destabilized the emerging markets in the other direction. It caused their currencies to crash. India and Brazil had massive currency collapses there, and their stock markets started to fall and everything. And so now, if we've reversed policy, that means that the hot money is going to start flowing back into the emerging markets. And we've seen that in the last week, where all of a sudden emerging stock markets are up big again. So these guys must feel like they are totally at the mercy of the developed world. Whatever we decide to do here has an outsized impact on these other economies, and there's nothing they can do about it, really. So as you said, they're trying to figure out some things they can do. They're talking about imposing currency controls and other capital controls, and talking about setting up their own version of the IMF, kind of a stabilization fund. And it won't be a surprise to see these trends continue and culminate in a plan to use their own currencies for bilateral trade rather than the dollar. So the fact that we're messing with these guys and making their lives so hard is going to lead to or accelerate the trend away from the dollar. And in the long run, this is a very big deal for the U.S. because the only reason that we can get away with the things that we're doing, this massive currency creation and keeping interest rates at near zero and running huge deficits of $6 trillion a year under GAAP accounting rules, is because the dollar is in demand all around the world. Everybody has to use dollars to trade, and when that changes, and it is changing, and we're accelerating the change, that means that dollars will be less necessary. Dollars will be sold by central banks around the world. The dollar will go down in value, and we'll have to start living within our means. So we're creating the conditions in which a new crisis hits us in the not too distant future. And we don't seem to be understanding that either. I think so much of what we're doing right now is short term. We're just trying to get through the week. and we're not really looking at the long term implications of what we're doing. But the emerging markets are a really interesting test case for the thesis that the dollar may not be needed for international trade to the extent that it is today in the future, and that has huge implications for us.
I would really encourage our listeners to pay real attention to the emerging markets and the BRICS and some of the Asian tigers, because I see that's where the crisis is going to come. And I have up a chart here, John, that I call the echo boom, and where the bubbles and the hot money have flown, and therefore where the crises have evolved is this hot money. And then we had the sudden beginnings of a reversal, the echo where it was coming back. And we caught that theoretically right at the cusp here by reversing the taper and stopped all of the flows. We've actually went back into the element of a potential currency war. But it's only a matter of time before that's going to fail. And then we're going to start to see failing from the current, same as in Europe, from the peripherals to the core. And it'll be the capital flight will start to accelerate, and then we will be really in a global liquidity trap. It's only a matter of time. And I think that the Federal Reserve with the taper pushing it off, and it will be pushed off because I think we're really going to what I'll call a global Abenomics policy here. Will stop. They'll keep the policy, will be accelerated. But at some point, the non-performing loans, the malinvestment, the mispricing is going to suddenly really cascade back in this echo boom as I see coming. But they've temporarily stopped it.
We are breaking this session at this point and will continue on the next tape number 2. We have a very large audio and iTunes listener base who have requested that the sessions be kept to approximately 20 minutes in duration. We'll be right back.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.